Have you ever wondered how a seemingly innocuous change in interest rates can create ripples in the vast ocean that is the stock market? Well, pull up an imaginary chair, for we're about to explore the fascinating world of interest rates and their impact on the stock market. First, let's dive into the heart of the matter. Higher interest rates are beginning to weigh on stocks, adding an unwelcome pressure on those stocks that are often purchased for their dividend yield. With the cost of borrowing going up, companies may find it harder to finance their operations and investments, which can subsequently impact their profitability and, by extension, their stock prices. In August, we saw a market pullback in both stock and bond prices. This turn of events has given pause to the flow of money off the sidelines. In simpler terms, investors are holding back, watching and waiting to see how the situation evolves. The rising rates have thrown a curveball into most outlooks. On one hand, we have the bullish investors, those optimists among us, who see falling inflation and are forecasting rate cuts by the Federal Reserve. On the other hand, the bears, the more cautious ones, are predicting a recession in late 2023. It's a classic case of different strokes for different folks. The impact of higher interest rates isn't limited to just stocks. They're also exerting pressure on mortgage rates, corporate bonds, car loans, and bank term loans. Higher borrowing costs make mortgages more expensive, potentially impacting the housing market. Similarly, corporate bonds, car loans, and bank term loans also become more expensive, affecting both businesses and individuals. As if all this wasn't enough, the uncertainty in interest rates is playing with investor sentiment, causing volatility in the stock market. Investors, unsure of what the future holds, are reacting to the changing interest rate environment, leading to fluctuations in stock prices. So, to sum it all up, the influence of interest rates on the stock market is profound and far-reaching. Higher interest rates can weigh on stocks, cause market pullbacks, create differing outlooks, put pressure on other financial instruments like mortgages and corporate bonds, and even cause volatility in the stock market. It's a perfect example of how a single factor can have a domino effect on the entire financial market. With that thought, we bid you adieu until our next exploration into the fascinating world of finance.